Chapter 16, examples for cost accounting. So in Chapter 16, we finish off our variance analysis by looking at productivity variances and further exploring our sales variances. So in this first example, we're going to look at partial productivity measures. So we start with a financial partial productivity. So we have financial and operating productivity. What we look at when we're looking at productivity measures is inputs to outputs. So our output is the number of units that we made. So we have our information here that we have output units of 400,000 in the prior year and 490,000 in the current year. Our inputs are the direct materials, and then we have inputs of direct labor. So we're going to look at direct materials first. So we used 160 tons at a cost of $3,375 a ton. And in the current year, we used 180 tons at a cost of $3,250 a ton. So we take the quantity of tons times the cost per ton to get our total direct materials costs. Our financial partial productivity for direct materials is output and total direct materials. So output divided by the input of direct materials. So we can see that we increased our productivity in the current year opposed to the previous year. We could also see that even though we had 90,000 more units of output, we only used 20 more tons of material, and we saved money on that unit cost. So the cost difference is $125 per unit. So if we did a full flexible balance or full flexible budget here for our direct materials variances, we would see that we would have a positive direct materials variance. The next one we're going to look at is our direct labor. So we have 10,000 hours for those 400,000 units of output and 13,500 hours. And then our wages per hour, take the number of hours times the cost, and then for our direct labor partial productivity, we take the number of output units divided by the number of inputs and the cost of direct labor. So we see that we had a change in direct labor productivity also. Then we would look at that as the variance analysis when we go back to chapters 14 and 15 and look at direct material and direct labor variances against these productivity measures. We're going to look at the combined productivity. So our output is still that 400,000 units from one year and 490,000 units from the other. Our total inputs are the direct materials cost and the direct labor cost. So our combined productivity, 400,000 outputs divided by 800,000 in inputs. And we can see our productivity measures. So we want to know what the management's decision to substitute one production factor for another was good or not. And this was a good decision because our direct labor productivity decreased. So we see 1.53 versus 1.51. and our direct materials productivity improved. So the decision to increase the direct materials productivity and reduce direct materials waste at the expense of direct labor was a good decision. Overall, we had a combined productivity for each dollar per unit. In this example, we're talking about the different measures of productivity based on our capacity utilization. So we also talk about this in chapter 15, where we talk about which level of capacity we should use for our overhead hours. So we have the ratio of output to input, where input is looked at as units of materials, labor hours, or related measure. An alternative we can use is the ratio of capacity available to capacity utilized. So if we follow this web link here, which I highly encourage you to do, there was a lot of really interesting information there. So looking at the measure of productivity based on capacity utilization with the measure used in the chapter of partial productivity, and which measure do we think is most beneficial? So the nice thing about the measure based on the manufacturing capacity utilization is that it's easier to think about as the rate of utilization of invested dollars. So what capital do we have available to us versus what capital are we currently using? It ties in with return on assets. So, and other key measure of business performance that we're going to talk about in chapter 19. And we also talked about in Principles of Accounting 2 during our financial statement analysis. And if you've taken business finance, you've also seen some of these ratios. So the productivity is measured by output divided by input in the chapter is really just focused on the labor force and labor productivity. Total financial productivity, that capacity utilization is a better measure for that. In this example, we're going to look at the sales volume variance and how we can break that down more, looking at sales mix variances and sales quantity variances. So we're going to look at the Q2 results and the Q1 results, and then a flexible budget for this information here about these two products, Starlight and Moonlight. So first we're going to build our Q2 statement. So when we're trying to determine what the sales dollars are, we would take the number of units sold times their percentage of the sales mix times the price that we have for that unit. And then for the Moonlight, 12,000 units times the 80% of the sales mix times the $85. So our total sales is $900,000. And if we want to look at the contribution margin by product, so remember the contribution margin is sales price minus the contribution margin, or minus the variable cost. So what we're looking here is our sales of 84,000 for the Starlight minus the variable cost of Starlight. So then we would take the 12,000 units times 20% mix times the variable cost per unit of Starlight. And for the Moonlight, we do the same. Moonlight sales minus 12,000 times 80% times the variable cost of $48. So our total contribution margin, we add those two together. Our fixed costs are $150,000, giving us an operating income of contribution margin minus fixed costs, $236,400. So we can do our quarter one information also. So for quarter one, we have 10,000 units times 25% times $35 for Starlight, and 10,000 units times 75% times $90 for Moonlight. And for our contribution margin, we would take our sales minus the total variable costs, 10,000 times 25% times $22. And for Moonlight, sales minus 10,000 times 75% times $48. So we see our information here. Now we're going to build our flexible budget. So we have our flexible budget, and then we can do our variance analysis. For a flexible budget, we take the 12,000 sales. So remember, a flexible budget is designed based on actual results. So 12,000 times the 20% sales mix times the quarter one cost. So flexible budget is actual results times our standard price or cost. So this would be our quarter one cost, quarter two results times quarter one costs. So 12,000 times the 80% mix times a $90 sales price. And for contribution margin, sales minus 12,000 times 20% times $35. And for Moonlight, we would take 12,000 times 80% times 48, sales minus And now we look at our variance. So we have a negative $48,000 variance in our sales price. But we have a positive sales volume variance. We have a negative sales volume variance with the Starlight, but we have a very positive sales variance with the Moonlight. So instead of 75% of our mix, it went up, it was 80%, and instead of the 25%, we dropped to 20%. But because of the cost difference between Moonlight and Starlight, selling more of Moonlight versus Starlight has a better impact on our sales figures as a whole. When we break these down, then we have our sales volume variance, and we're going to break this down in sales dollars. And in contribution margin. Well, so we see our dollars here and our contribution margin here. How we can look at that in a different way so for Starlight, we have that we planned or we sold 12,000 at 20% of sales mix, and we were budgeted to sell 25%. And our $35 sales price. We can see here that that's a negative $3,500. We do that for both the Moonlight and the Starlight for contribution margin and sales dollars, and we'll get the same numbers as the variance that we have here. Let's look at instead our sales mix variance. So if we have a sales variance, Starlight, Moonlight, we're going to have the sales mix variance, sales quantity variance, and the sales volume variance. Our sales mix variance is the fact that we sold, so we have our 12,000 units times, and we sold 0.2 when we budgeted for 0.25 times our price minus the contribution margin. We have a negative $7,800 variance. For Moonlight, we have 12,000 units times 80% minus 75% times $90 minus $48. We have a positive $25,200 sales mix variance. For our sales quantity variance, we're going to take units from quarter 1 minus units from quarter 2 times the sales mix for quarter 1, 25%, times our contribution margin, 35 minus 22. And then the same thing for Moonlight. 12,000 units minus 10,000 units times 75% times 90 minus 48. And what we see then is if we add these together, that they equal our sales volume variance for contribution margin by product. So we've broken our sales volume variance down into sales mix and sales quantity variance. In our last example, we look at a productivity for a service industry. So we have a family medical practice clinic with physicians, nursing staff, and administration staff. And we're trying to determine what our measures are. We're going to look at industry. So we have industry average. We're going to see how we compare to those. So we're going to compute the partial financial productivity ratios for nursing and administrative support for the current and prior year. So what we're going to do first is figure out what our total cost was for both years. So the total nursing cost for year one is the total number of nursing hours used times the cost of nursing support per hour. And the total administrative cost is the administrative hours used times the cost of administration per hour. So for our productivity measures for nursing, we would take the total number of patient visits divided by our total cost. So 33,000 visits divided by our nursing cost, and then for administrative, 33,000 visits divided by our administrative costs. And we do the same thing for the prior year, 28,600 patient visits divided by the cost. And then we're going to do 4 decimal points as requested by the problem. So we can see what our measures were in the current and prior year. We can look at the industry average and where we compare to the industry average. So we're also going to do the operational partial productivity. So for this, for operational, we're looking at the number of patient visits to hours instead of to a financial measure like the financial partial productivity. So 33,000 patients divided by 20,300 nursing hours, and 33,000 patients divided by 13,425 administrative hours. And then the prior year nursing hours versus administrative hours. And our current output at prior year productivity. So this is what would our hours have been if we had stayed at our prior year productivity to maintain those number of patient visits. So we take the number of patient visits divided by the nursing productivity from the prior year, and then the number of patient visits divided by the productivity measures for administration from the prior year. And so we see that if we had maintained the prior year's operational productivity measures, we would have had 22,384 hours for nursing, and we had 20,300, so we're more efficient, and 15,490 hours administrative. So we can see that overall, we were more efficient in our operations numbers. What number 2 then asks is the change of the partial financial productivity to the current year into productivity changes, input price changes, and output price changes. So that is what we're looking at here. And what are our total changes? So we have these current output at current cost. We figured that out. So that's the 0.417. And administrative 0.01. $962. And then we have at the very beginning, that was 3.88 and 0.888. So now what we need to calculate is the current output divided by the current output at prior period production times the prior input cost. So for this one, the current output divided by the current output at prior period production times prior input cost, we take what our hours would have been if we had kept last year's productivity. So this is our patient hours divided by, we need the total cost. So for nursing, 22,385 hours times a cost of $38 per hour. And for administrative, the 33,000 patient hours divided by 15,490 times 24. So we can see that those hours are the same as the prior period. Now we look at the current output of patient hours versus the prior period, what we would have been at the prior period's productivity, and our current period's prices. So 33,000 divided by 22,385 times $39 per hour. And 33,000 divided by 15,490 times 25.56 per hour. So what we can see here is we have a variance So we have a positive variance in our productivity change, we have a negative variance in the input price change, and zero variance in the output price change.